Okay. Good evening, everyone. I'm delighted to welcome you all today to the second currency webinar for this year, where we present a macroeconomic update, specially simplifying the global currency movements for you. At HSBC, we have been continuously striving to add value to our banking experience for our esteemed Premier and NRI clients who have a global mindset and international needs, from repatriation to global investment opportunities. Hence, these webinars are specially curated to share some of the key insights on currency movements so that we equip our clients to take informed decisions. You would recollect that last month we launched our webinar series called Demystifying Currency Movements, where along with the macroeconomic update, we also delved deeper into how some of these various macroeconomic factors influence the global currency movements. We saw a heartening response there, and we also received some great feedback from our customers on what else they would like us to cover in these sessions. So for today's session, we will simplify how inflation impacts currency movements. Let me now invite my esteemed colleague and the expert, Mr. Manoj Goyal, who is the head of corporate sales for the markets and security services business at HSBC India. In his role, he is responsible for managing the flow FX sales and derivative piece for the corporate clients. He has a financial market experience of more than 18 years, especially across FX and structured solutions, and has been with HSBC since 2005. Manoj has been actively involved in the development of the derivative and the FX market in India due to his association with various industry bodies such as Foreign Exchange Dealers Association of India. I would request you all to keep your questions ready for Manoj, which he can address shortly after his presentation. You can also post your questions in the comment section. Without further ado, I now invite Manoj to take the session forward.
Thank you, Nishtha. Thank you for the introduction and a very warm welcome to our audience on this call. we had a conversation last month, so I would not spend. I'll briefly touch upon what has been happening in the market since then, and how we have seen the currency market move. But more importantly, as Nishta mentioned, I'll be focusing more about inflation, and more importantly, how inflation impacts currency moves, and a little bit going further into details on what kind of inflation parameters we track, what has been happening across the globe, and why. Because I'm sure you have been hearing a lot about the high inflation, not only in emerging markets such as India, but more importantly, this time around, what has been happening in the global world, and how that has been driving the Fed rate decisions, other central bank decisions, and the resultant impact on currency. So first of all, just dwelling a little bit about what has been happening on the currency market. In fact, this year has been very, very interesting. Quite unlike, I would say, last 1.5 years. If you would recollect, and some of our audience who have been attending some of the calls which you have been organizing through last year, early this year, you would recollect largely from 2021, middle of 2021, we have started seeing a move up in dollar, and it has been a very, very strong dollar move. I mean, we have just tried to portray the currency movements from last January till September, and from October onwards, because I would like to just highlight two distinct period what we have been seeing the currency moves. But even if I go prior to January 2022, we had seen dollar strength manifesting in various ways. And if you look at the relative movement in the currency, in fact, some of these numbers which we are seeing, let's say for British pound or euro, would have been much negative, or the depreciation in these currencies would have been much worse if we had drawn slightly longer period from somewhere from mid to third quarter of 2021. But clearly, the era was of a very strong dollar strength, and kind of relatively unprecedented, because there are very few periods when we have seen such a sharp move in dollar, and that too across currencies. Now, the interesting part, if you look at this chart, is these moves have been across the spectrum of currencies, including all the mighty G10 currencies. I mean, you look at over here, we have British pound, euro, Japanese yen, Australian dollar, as well as you have currencies, all the emerging markets currencies. But interestingly, the movement in global currencies, in developed market world currencies, have been significantly worse than the movement which we are seeing in emerging markets. I mean, right from the table, if you see rupee just moved around 8 to 9% during this period, whereas like British pound was around 17%, euro was at 13%, etc. But from then on, we have seen a phase where the dollar has started to give up its strength, and partly that has been coming from the little bit of change in expectation of Fed rate hike cycle. The Fed has still continued to give more hikes during this period, but as in financial market, it is not about what you're doing right now, but the market looks for what would happen on next few months or the year to come. And that is where I think there has been a change in expectations, where it is being felt maybe Fed is approaching peak US rates or the end of its cycle. Now, it's debatable. I mean, both of these things are debatable, whether Fed has reached it or closer to its peak, or more importantly, how long Fed is going to keep this interest rate at these levels. I mean, while we may be talking about the rates, whether they're reaching peak or not, but the fact is US rates are at a very, very high level. I mean, last time, when can we think of dollar rates at 4% level, and we're talking about rates approaching, in fact, 5% level. I think we have to go back to 2007 to look at these levels, and it has a profound impact on how the currency would move. So coming back to the second period, I think we're in the midst of this debate whether what is the future trajectory of currency movements from here, and that is what has been driving these moves in currency, or the strength of the other currencies across dollar, euro, pound, yen. Some of these currencies have gained back around 7-8%. In fact, in some of these currencies move, it has been a much larger gain. For example, yen. If I just talk of dollar yen level, it had crossed 150 sometime last year, and it's now way below 130. So the move has been much sharper and larger. But the interesting part over here is rupee. I mean, if you look at this table, only rupee is still appearing in red. Now, does it mean rupee is behaving very differently than rest of the currencies? I think we need to just not look at this chart in its isolation, but we also need to look at the left-hand chart where we, as we briefly discussed earlier, rupee had not depreciated to the extent where other currencies had during, let's say, in the face of dollar strength. Largely, I would say, due to active, management of its currency by market participants, including, the central bank, which quite clearly is visible in the foreign exchange reserve what the country has. So in a way, it could be seen that the underperformance of rupee in last 3-4 months is just rupee catching up. Now, if you look at cumulative basis from, let's say, January till January 2022 till February 2003, and we look at, okay, how in totality the currencies have reacted, maybe rupee will be very similar to some of the other currencies movement. So that is where I would just like to just explain about why rupee has not been moving that much as other currencies. From the And if I just take last couple of weeks, I think again we have seen some bit of change in currency outlook or currency movement. We have seen a bit of, again, expectation changing on where Fed could be in next few months and what is the trajectory of Fed rate hikes, especially given how some of the inflation data has been looking like. And that is one topic which anyway we want to dwell deeper into later part of my conversation. But clearly there has been a bit of change over there, which has resulted some bit of dollar strength in last couple of weeks. So we have seen currencies such as euro, GBP, etc. again giving up some way, not very large, but 1 or 2% kind of movement back in these currencies. So overall, as against a period where we saw pretty much one-sided move from pretty much large part of last year and 2021 dollar strength, the last 3 to 4 months of dollar retreating and giving up way, and last couple of weeks when we are seeing relatively two-way movement and looking that nothing is very clear. I think this year is looking like we will have two-way movement, and it will be more dependent on how data behaves, what kind of data comes up, what various central bank across the world do around that data. So yes, I think currency markets are always like that. It was slightly easier, I would say, last year to look at the momentum and see directional movements in currencies. But this year, I think we will have both of two-way movement going forward. Just moving on from there, coming back to the topic and what we thought, let's go deeper and let's try to understand some of the concept or some of the market variable which impact currency movements. And as I mentioned, inflation has been one thing which has been coming up very increasingly in the markets conversation since last year. And one way, if we can look at why, I think the reason is very simple. I think we have tried to portray the chart in CPI movement and the dollar index. Clearly, if you can see very strong correlation, just looking visually in the chart, the currency movement has been quite regularly following the CPI movements, and of course it comes with a lag, and that is the reason why we focus so much of inflation. But inflation is not does not directly impact. It's in second order, because if inflation is higher, the central bank needs to act and they raise rates, and as a result of that, then we see the subsequent movement coming on currency. So in a way, you can say it's a the linkage is secondary, not absolutely directly linked. Unlike, let's say, the trade data or something which we discussed last time around balance of payment, etc. That's directly first order impact. And similarly, rate movements are directly, interest rate movements are again something which impact currency movement directly. What we see is inflation impact them indirectly, because if inflation is higher, the central bank have to act to bring inflation under control, and that leads to higher rate action directly. And that is what the linkage is and this movement show. Now, just commenting back a little bit on the rate hike cycle, as we see from this graph, The rate hike cycle has been very, very strong and very, very brutal. We have not seen this kind of rate hikes pretty much in last 15 to 20 years of US rate movement. So this is very, very strong. And as I said earlier, we are approaching now 5% handle in dollar. And just to give some perspective, I think in pretty much last part of 2022, the operating interbank rate, what we use in domestic market as the call money rate level, were pretty much sub 4% level for quite large part of 2020 in INR terms. And here we're talking about dollar interest rate being closer to 5%, which has been closer to 0%. So clearly, there is a lot of linkages of what's happening from inflation, interest rate, and currency movements. Changing, the discussion a little bit and slightly go slightly deeper over here. Just going back to the basic. Now, what is inflation and what is the various benchmarks when we look at what is, when we talk about a country, what kind of different measures there could be. So the two most commonly used benchmarks when we talk of, or the parameters when we talk of inflation is WPI, which is known as wholesale price index, or consumer price index, which is CPI. Generally, many countries, publish both these data and different meaning and different implication, and the way they are used by central bank or market participant also differ. Going slightly deeper over there, essentially WPI tracks inflation at the producer level. And as has been clearly from a consumer price index, it captures the price level at the consumer level. Now, one other difference is WPI largely captures changes in the goods, etc., just by nature of its being wholesale price index. And accordingly, we have more weightage given to manufactured goods in WPI, whereas in CPI, the weightage is slightly more, I would say, well diversified. It is more to services, other items, and food items, etc., which is slightly, I would say, more representative in a way to what consumers ultimately are feeling on their day-to-day life. And that's why generally across the globe, we have seen more weightage given to CPI, but not to say WPI doesn't have its usage or meaning. India, till few years back, used to follow relatively more WPI, but I think I don't recollect exactly when, but we started publishing and giving more weightage to CPI. Now, when generally we hear from regulator, from policymakers, when they talk of inflation, normally by default, you can assume it, they are talking more about CPI rather than WPI. And when we look at the formal target which central bank has from the government of India, they are targeting CPI. So as some of you may know, the central bank has provided a rate band of generally they target 4%, but within a range of plus minus 2% of that 4% is something what central bank try to achieve. And when we say that, that is being talking about CPI. Now, quickly going deeper into CPI, we have tried to provide the breakup of what is the weightage of various components which goes in determining CPI. Clearly, food and beverage is the largest component, which has a weightage of around 46%. We have fuel, we have housing, clothing, in fact, items such as pan, tobacco, etc. And then, of course, there are some miscellaneous items. Now, I'm just trying to, we're just trying to provide this breakup so that it's very clear, some of these parameters would move differently depending on the dynamics of the, situation on ground. For example, weather, monsoon, etc., would impact food quite a lot. But, housing may not be dependent on that. And there could be different period when some of these different items may have different dynamics. And ultimately, it's a composite number from a CPI perspective, what matters. But when central bank are looking at that, and they also acknowledge that some of these parameters may be dependent on some short-term, impact, which may not clearly fully reflect how the economy has been behaving and how the inflationary pressure are. For example, the item which I mentioned about monsoon, and let's say right now the way we have been seeing the relatively more kind of heat wave, which has started a little bit more earlier than in the earlier, and there are talks and concern, would that impact the winter crop, and accordingly what is the impact on the inflation because of that. Some of those impacts can be more short-term in nature, and hence the economist, market participant, regulator, they try to go deeper into to go some finer element of inflation. And that is where, while we know the headline inflation, which I talked about earlier, but they also focus on what is known as core inflation. And to keep it simple, the CPI, the headline inflation, minus food and beverages and fuel and energy. If we strip out these two component, what is remaining is what we talk about core inflation, because it is felt that the impact of core inflation can be slightly more longer term in nature and relatively could be more dependent on the central bank action, right? I mean, central bank impact on what happens in monsoon is very, very limited, right? But the core inflation is something where they can impact a bit more, and that is where they try to focus, on that as well. So I think it's important, all these parameters, WPI, CPI, headline inflation or core inflation, all of this matter and provide different interpretation and different view of what is happening on the economy, so that then the central bank can act accordingly. Just talking about why we have been talking about inflation and why and what is happening over out there. What we try to portray, these are international prices, not really domestic only. We try to capture wherever we can get domestic price or wherever we try to capture the international price. But by and large, you know, uh, and we have tried to portray where the levels were in 2019 for some of these commodities, and where the levels were 2020. But more importantly, what has been the peak level for some of these currency. The peak level could have come at different point in time, but broadly we have tried to capture in last 3 to 4 years where the peak levels would have been for these currencies. But by and large, most of this have been around last year in March and April. And we have in the past cases or situations where we have seen, let's say, one particular commodity going very high level because of local dynamics or some peculiar situation which might be happening to that currency. I wouldn't think that what is the peak we have provided over here in this chart could be all-time peak on some of these commodities, because there's a possibility, let's say we talk of aluminum sometime past, they were at a very high level. But the interesting part is, because of various reasons, and some of that was driven by supply chain issues which are having due to pandemic, but then subsequently the Ukraine invasion by Russia also drove some of this movement. But if you look at these levels, practically around March or April last year, we have most of this currency hitting their peak together. And if you look at over there, the increased the percentage change during from peak to what the level of 2019 were, practically for large part of these currencies, these commodities, it has been 100%, 80%, 90% over higher. Some, of course, has been slightly lower, but on an average, if you look at that, all these commodities have moved to 70, 80% on an average, right? I mean, which is a very, very large movement. And that is the reason why we say the inflation has been very, very high, number one. And number two, inflation has been not only in some segment or some part of the globe, but it has been quite widespread in emerging as well as global markets. Interesting point to note over is, since then, the commodity prices have come off. We have, at least right now, if you look at the prices, practically they were talking about 40%, 50% as against 100%, 120%, etc. from its peak. So the commodity prices have moved up, but still they are almost around 50% higher than what they were in 2019. Moving on from there, so all this commodity prices movement, of course, has been feeding in the CPI, WPI for India, and we will we'll look a while after on how it has been moving in developed market. As we have seen, the inflation has been inching up. The WPI has, normally what we have seen is CPI comes with a lag. For example, in this chart also, if you pick up a particular point, the WPI for that corresponding point may be higher than CPI when the prices were going higher, and as commodity prices have started to move off, we have seen WPI coming faster than CPI. So clearly, it's a lead and lag impact between WPI and CPI. But practically, since last 1 year, the inflation has been higher end of 6%. Now, in between, we saw a print of below 6%, but even right now, it is out of what is the RBI tolerance zone of higher end of 6%. WPI has come off, which means the producer are not facing that much pricing pressure as what they were facing earlier. If you look at middle of last year, the WPI was as high as 15%. Again, a reflection of how strong the pricing pressure as reflected by the commodity prices, which I discussed earlier, were for the producers. Lastly, I think this is an interesting chart. While in India, I mean, all of us are, used to 6%, 7%, or if I go back 10 years back, 10% used to be norm for inflation. So I think normally when you talk of inflation being 6%, 7%, I don't think it ruffles so many feathers in India. But when you look at from a developed market perspective, I try to capture inflation from US, from Europe, from countries such as UK, let's say, the inflation has been pretty much at 8% plus level. And that is where the challenge is coming up. Most of this, I mean, we had plotted the chart here from the last 10 years, but even if you go, period before that, these levels of inflation of 8%, something which developed market hasn't seen. These are unprecedented levels. And that is why all the concern and all the impact what is coming around in these countries, and a rush to bring under control, because 1 to 2% inflation is something which is these countries target around, depending on various country, but generally 2% is a number which countries target, and even they uh, find it difficult to even achieve 2%. We know Japan, I mean, the inflation number for Japan has been a target forever, for quite some time. So this is a result why we are seeing so much of pressure, and as has been the case with any country, inflation at this level impacts all part of the population, of course differently, but it does. And many of these countries are going to have elections coming up in this year, next year, and again, something which no government can take it lightly. And that's where so much of focus on inflation, and as I said, that is feeding into interest rates, and then that is feeding into the currency movements. Nishta, maybe in the interest of time, I know it's been 25 minutes since I've been broadly speaking. I will pause over here. Happy to take some questions if you have, or if you may have from audiences. Thank you.
Sure. Thank you for the insightful session, Manoj. I'm sure some of our clients must have found this session extremely useful, and they can now relate to the various news articles and reports that we keep reading. Hope we've been able to truly demystify some of these aspects for our clients and should hopefully equip them for more informed decisions. We have already received some interesting questions, Manoj, from our viewers, and maybe you would like to address them. In the interim, you all can keep please pouring in the questions in the comments section. And along with the questions, we would also like to hear from you any feedback on how you found this session and if there are any specific topics that you would like us to cover in the next series. So Manoj, to moving on to the questions, we have got our first question, and it states that what are some of the factors that you think will support INR and some major risks that we should be considering?
Yes, so there are various things, Nishta, which has been driving currency, and now we did talk about the global situation, but when we come specific from a rupee perspective and domestic basis, what has been happening? As I mentioned earlier, it was rupee's underperformance against other currency was more of a function of rupee catching up. It has not depreciated last year that much, so it did depreciate lately against dollar and other currencies. Now, could we say the relative movement or relative underperformance or overperformance has been adjusted? By and large, looking at this currency movement, looked to be the case, given how much rupee has underperformed in last 3-4 months versus other currencies. So in a way, one quick way or very very quick way can be that now it's back to dollar index or globally how dollar moves. Clearly, it would have an impact of what happens to rupee, and that is something we need to watch out for. Uh, I briefly touched upon the change in expectation on dollar globally as a result of change in expectation of what's happening to dollar rates. Um, Starting of the year, market went into this year expecting rate hitting its peak and some bit of probability of US rate cuts towards end of the year or early next year, and quite strong expectation going around there. Now, I will just like to link it now back to the inflation, commodity prices, which we talked about, and some of this expectation was coming because the inflation had started to come down, still way beyond the tolerance level or the target level, but I think it is the trajectory. From that 8% level or the higher level we're talking about, it has started to come down, and that is where market started to look at maybe the Fed would start thinking differently. Uh, Two things have changed over there. As one, we briefly, so some of the commodity prices have started to inch up. Like if I take of last 3 4 or last quarter of last calendar year, practically the commodity prices have moved back almost. It will vary from commodity to commodity, but it's fair to say on an average 30% kind of movement down we had seen from its peak from the April level, and that was one of the reasons why we saw the inflation moving down. But since then, and more importantly, as the now we are hearing and seeing early days, but as China is starting to reopen, given its COVID challenges, the commodity prices have already started to react with that, and they're already way higher than what they were at the from its lows of late last year. Right, that is one part. Second part is again the impact of US rate on US economy, as well as rate hikes in other economy, the impact of the global growth. Now clearly, no doubt, global growth is expected to come down this year, but somehow some of the economies are doing far better than what would have been expected when Fed started raising rates. And especially US economy, that seems to be doing quite well. And as China opens or reopens, I think again the demand which could be coming from China, and again putting the pressure on commodity. So I think if we combine all those things, there is a bit of concern around what is the inflation trajectory, and would central bank need to do more to bring that under control. And that has again led to rebasing of the expectation going forward. If I talk about, let's say, what is the market expectation of 1 year rate 1 year down the line, right? That has gone significant change. The exact number will vary, but I think fair to say something like 70 to 90 basis point they have gone higher, which means the people who are expecting rate cuts coming by year end or early part of next year are repricing that, and that is providing some support to dollar. So from a global context perspective, there is some rebasing, and we need to watch with dollar, and that will definitely impact dollar rupee. Closer home, and this year the growth is expected to be lower than what it was last year. Generally, if you look at even from the RBI, what they have given their outlook for next financial year, and that clearly bring down some of the trade deficit which we have been seeing, because normally when GDP is going faster, you see more capex support coming from that perspective. But even on trade deficit, which has gone to very high level, and we have spent decent amount of time during our last webinar on looking at trade deficit and balance of payment. But some of the components over there are looking better to us now than what they were earlier. Not to say trade deficit wouldn't be high number, but it may be lower than what we have seen on the average, because all these commodity prices lag. They come with a lag. Like if oil prices move from 140 to 90, there are payment terms once you buy, etc. So those impacts it takes some time. Now it's debatable depending on the industry, etc. 3 to 6 months for that to play out. And that is what we're already seeing happening in trade deficit. So what you're seeing is trade deficit is becoming better than earlier. But when we look at the other component, which is, let's say, service exports, they have been growing quite well. And in fact, if you look at last 1 or 2 months data, they have become very strongly. Again, helping to manage our trade deficit in some shape and form, and current account looking slightly better. So I would say, given last year was a scenario where there was very strong dollar global movement or pressure on all currencies, including rupee, and at the same time, from a supply demand perspective, the current account or trade account was looking quite relatively bad than it has been earlier, and that pressure seems to be much lesser, relatively lesser now than what it was during last year. The only part is on the capital flows. I think we have yet not seen any I would say that remains still muted if I talk of foreign portfolio investors, or if I talk about FDI also. So these are some of the things we need to watch out, and I think it will keep changing quite rapidly, I will say, as things go along. So we can't really say now it is an era where we're saying, okay, rest of the year, one way movement or will be under pressure or more. it will broadly move in line with what is happening globally and on some of these parameters which we need to watch out for. And of course, last bit, which when we talk of currency, we do need to talk about is the central bank action. Uh, they had the reserves had come down significantly last year. They have been off from its lows, clearly, as they have tried to build up reserves. Again, it depends on what is the central bank activities and what is the reserve level they are looking to build up. So if we start seeing more flows and current account become better, would they start accumulating those reserves a lot more? So that is again a very, very important factor in determining where rupee would.
Okay. Thank you, Manoj. This actually answers one of the questions that we had received, that given the higher inflation prints, does that call for another rate hike by the RBI? So that actually answers that as well,
Yeah,
unless
so
you want
maybe
to add.
just to comment a little bit on that, because the question is specifically not on currency but on the interest rate side. Yes, I think as I said clearly, not only we're talking about Fed rate and could that rate be higher. Similarly, for rupee perspective, also after the last rate hike, which took repo rate to 6.50, clearly there have been certain houses which has been calling maybe would RBA pause over here and would they go beyond that. But I'm sure as inflation data and the last print on India, we looked at the earlier slide, the last print on CPI for India was 6.52, which was again higher than the RBI tolerance zone or the band which they would like inflation to be. Clearly, there could be a bit of reevaluation, or should there be another rate hike going forward from here. So, and also what we also need to keep in mind is, let's say if you talk from various parameters, talking about Fed rate at 5% and let's say repo rate at 6.5%, I think the differential between developed market and emerging market in terms of dollar and rupee rate is very, very small, which if you look at historically has been quite higher. Now that also has a profound implication on the capital flows. Ultimately, some of the flows which are coming into the emerging markets are also looking for higher yield. The question is, if you're looking at 5% in your home market in dollar terms, would you like to take on additional emerging market risk and invest in emerging markets? And accordingly, another factor which RBI would need to consider when they're looking at what should be the terminal rate for India. So, Mr. Yes, I think it has opened up debate that more hikes in India also. It has opened up and potentially could lead to.
So, Manoj, with this overall conversation that's happening on the reserves, etc., do you see risk for RBI's 5.7% forecast for the year?
Sorry, this will be the forecast for which parameter?
So they're saying that with the current inflation numbers, that the inflation being much higher than the month before and the expectation, what risk do you see to the RBI's 5.7 forecast of growth?
So yes, I think there are 2 points I would like to talk about. I think the global, the discussion and debate we just touched upon, because of the, let's say, China reopening, what does it mean, and the global demand on what it will do to commodity prices. And of course, you will have it feeding into rupee and India as well. I mean, we are very much connected with the global market. So that is there. But if you go just slightly more granular locally, what has been happening locally, see, there have been different phases in India. If I took at last 1.5 years from a local dynamics perspective on inflation, one part is clearly the pent up demand post pandemic or during pandemic also for goods. That continued for a while, and that was one of the reason why, let's say, start large initial part of last year or way back in 2021, we saw very strong demand, and large part of the component of our GDP was driven by goods. And as country opened up, we started to see a lot more service demand. I'm sure many of us whoever traveled or looking for hotel accommodation, etc., we know how difficult it has been to get that going on vacation. The flights availability, forget about the price, the flight availability and other form of service related demand. So later part of last year, we saw service demand picking up. Now this year, there are 2 things happening which will be interesting, and a lot of it actually talk about this debate between urban and rural. How the wage inflation, other things are panning out differently in 2 segments, and more importantly, what is the weather impact. Now, the weather impact is very, very important in India, given the strong linkages to agriculture and the second order impact of agriculture. Now, one part we saw last year when post monsoon, given the monsoon was good, we saw the the crop activity or the that increased significantly, which meant more demand for rural labor, and accordingly the rural wage has started to inch up. Now, if the crop is good, even this year, we're waiting for the winter crop, etc. Quite likelihood the disposable money available in the rural sector could be better, which can lead to more demand. But at the same time, if we see that um, this weather impact, the heat wave impacts winter crop, and it impacts it negatively, then while it may not lead to that rural inflation you're talking about, but at the same time it has profound implication in general for the inflation, given the large impact in that inflation weightage we saw of food and beverage item, right? So I think these are some of the dynamic which will play around what happens locally. It will act in different manner. The rural is may lead to more goods demand, whereas the negative impact can lead to high CPI number. So I think we are just looking from these two perspective the impact, and clearly I'm sure what's happening globally, even the central bank would be looking closely on their forecast on inflation.
Sure, noted. Manoj, we have just now received another question. It says that INR has been an outperformer as compared to other currency pairs in the last couple of sessions. And we have seen the currency pair to be very range bound with very strong support around the 83 levels. How do you see USD INR performing in the upcoming months?
So, Nisha, I think large part of this question, in a way, I've already answered when I talk about the risk factor views on rupee. But just I would like to just add one comment on this. So when you talk, maybe when we're talking about this overperformance of rupee, this may be last few weeks which has been talked about, because last 2 weeks, as I mentioned, euro and GBP etc. have moved by close to 1 to 2%, depending on the exact level when you take it from. But rupee has been pretty much around that 80 to 70, 80 to 80, in that zone. It has not depreciated to that extent. But as I discussed earlier, last 3-4 months, rupee has very strongly underperformed other currencies. So it's more of catching up, and while there are global correlation, there are linkages, but it also depends on various some of the other local factors how currency move. So in that context, now rupee has not depreciated beyond 83 because of a certain level, and as has been the case from the, I'm sure the central bank is also monitoring the situation very closely, and it also a function of what level they are comfortable, what reserves level they are looking at, etc.
Thank you, Manoj. We don't have any further questions. Any last words from you, or we could look at closing?
No, Nishita, I think just would like to thanks our audience for joining in. Our endeavor has been not only to bring about the market levels. I'm sure our audiences have much more access in today's day and age of internet and social media, etc., available on the levels what the currency movement is. The idea is to go slightly deeper, to look at what has been happening, but more importantly, to share some of the terms, some of the market parameters, how they impact currency, so that maybe when our audience are looking at more news item, and tomorrow they hear another idea about, yes, the rate, the dollar is looking stronger because inflation has been inching higher. Hopefully they'll be able to better correlate with what's happening on that. So on that note, Nishta, thank you from my side.
Thank you so much, Manoj. It was really, really insightful, and I'm sure our viewers have got some great takeaways from today's session. Thank you all for joining us today. We will continue this insightful series to make global currency movements simpler for you. Knowledge is indeed the fuel for growth, and we truly intend to equip you with the right information. Looking forward to host you all again in the next session. Have a great evening.
Thank you.